Now, in terms of the opening take, the Nifty is consolidating above 25,000. It's a gain of about 60 points. And this would be what, 8th day that the markets are up in the green, at least for the benchmark indices, supported by IT today, and mid-caps are outperforming.
Well, that's right. Take a look at JBM Auto. That's flying away. That's up closer on 6%. Big move is what you're seeing on JBM Auto. Pull up a couple of other names. I think Sigachi was the stock that Hormuz was talking about yesterday. That's up closer on 4%. Volumes are massive out there. Brain Bees, yesterday there was a very large trade, I think of around 28 lakh shares on Brain Bees. That's got out of the way. The stock, in fact, is higher. It's up closer around 2.5%. So we'll keep an eye out on this particular counter as well. Vare Energies, everyone was talking about maybe there is no big visibility in terms of earnings and the likes. The stock has done very quickly, 2,300 to around 3,800. Just take a look at the recovery on that particular name. Massive move is what we're seeing out there. HFCL reacting to positive news flow, so that's higher. Lodha as well is higher in trade today. So pretty good start, particularly for the broader markets, and that's why your portfolio will be feeling quite good this morning. AQ Lighting, yesterday as well the stock did see a rally. For this week itself, it's up more than 10%. And in today's trading session on large volumes, that one has bounced up closer around 5%. And the other one is Precision Camshaft. It saw a big run this week, and then in fact it saw some kind of profit taking, I think, yesterday. But for the time being, that stock has opened up with big gains. And a viewer just messaged me that happy birthday. And Nigel, last year on your birthday, the markets rallied. I just went and checked that data point. The markets are up close to 2% last year on 12th of September. So if the markets rally, I don't mind taking some kind of, I don't mind that it could be because of me. If it doesn't, then it's the market for you.
It's not a problem. Yeah. It has nothing to do with the date.
By the way, BSE and Angel One are also recovering. After yesterday's big gashes down 4-5%. Today, BSE is up close to about 2.5%. Angel One is in the green. And Jeffrey says that even in the worst case scenario, the valuations is still pretty okay for BSE. I think they've put that number out, 30 to 40x in terms of FY27 PE. So they believe, in a way, the downside could be protected from here on. So they've bounced back. And Astral is the other one. Nimesh was highlighting it in the standout brokerage report. The target price set by JPM is 1,700 rupees. Astral now is sub 1,500. So they see upside. Stock is pushing up.
Absolutely. And when it comes to these capital market stocks, one can only hope that there is a quick clarity on the regulation as soon as possible. Of course, our story is, what Yash had put out yesterday was that there seems to be a conversation of completely doing away from the weekly options products and only having one single monthly expiry across all exchanges, all products. So let's see. That's one school of thought. That's what we are picking up.
And there's a SEBI board meet. There is a SEBI board meet today.
Yes. So the sooner, we have the final regulation, the better. You can just sort of,
let's see whether they deliberate, discuss on it, and we get any kind of sound bites or clarity.
Absolutely. Otherwise, the market's fine. In the mid-cap space continues to bounce around. Plenty of stocks which continue to find traction. Some of the defense names, by the way, we'll have a discussion on defense in just a bit on this 15-year roadmap. So some of the names like MTAR, Paras Defense, they are actually fairly excited today as well, 2 to 3% higher. On these ones, MTAR and Paras Defense, on the private sector names, they are up and about this Friday morning. So let's take the conversation forward. Manishi Chaudhary, CEO of MR Capital Partners, is with us. Manishi, great to have you on. Thanks for joining in. So, GST bonanza, income tax cuts, RBI cuts, all of it is coming together to really lift sentiment in the market. And the market's also responding. The question is, can it really translate into better earnings? Where are you, Manishi, on the earnings estimates for this year after Q1 and after the range of policy announcements that have, that have just taken place?
Thank you very much for having me, Surbhi, and a very good morning to your viewers. First of all, the earnings environment in India for the past year, right from September 2024, has been quite bleak. We have seen consistent earnings estimate downgrades over the past year. And it hasn't stopped over the last 2 quarters. So one will have to watch very keenly the result reporting season for this July-September quarter, which will be across October and November. I have a feeling that this might turn out to be the worst quarter before we have a certain degree of, bottoming out of earnings estimates and a gradual recovery in the beginning of next year, in the beginning of 2026. The reason why I'm saying this is, number one, There's a lot of fiscal and monetary stimulus that has gone in. If you look at the latest GST cut, that is something around 0.5 to 0.6% of GDP. We have had the jumbo rate cut earlier, and RBI, believe me, has a lot of dry powder. Today the real policy rates are close to 4%. It's only been twice as high as this over the last decade. So RBI, even though they have cut by about 100 basis points, they can cut potentially by maybe another 50 to 100 basis points spread over the next 6 to 12 months. So, number one, we have had a lot of fiscal and monetary stimulus. There's room for more monetary stimulus. At some point of time, this would have an effect on the domestic consumption and investment environment. We're already anecdotally seeing that. There are, the signs of demand recovery in automobiles, for example. We have seen some companies cutting prices even earlier than the September 22nd deadline. So, I think we will have to watch out very keenly for September, for the September quarter results to come out across October, November. But beyond that, I think there's a case for earnings estimates bottoming out and beginning to revive.
So Q2 should be the bottom, and Q3 onwards, things should start on an uptrend. Manishi, hi, morning. When we last spoke, you said you were completely avoiding IT and I think consumer staples. We'll get to IT, but first on consumer staples. Is there a case for a buy on consumer staples FMCG post the GST cuts?
Well, there would be some benefits, no doubt, to that sector. But at the same time, look at it this way, that consumer staples are well penetrated across India. And that is why, for years and years, the leading consumer staples companies are reporting top-line growth in the mid-single digits. At the same time, they trade somewhere between 40 to 60 times PE multiples going forward. So in a nutshell, a single sentence answer to your question would be no. Despite this GST cut, I'm still not enthused about the consumer staples universe.
All right. Hi, Manishi. Good to see you, Ben. Manishi, the theme that has a longer runaway has to be some of these stock market plays. The problem is, in the last 24 months, they ran so hard that they've all come in for profit taking. Case in point being the exchange that's listed, that's BSE. From more than 3,000 rupees, it's closer to 2,000 rupees. You have Angel One, another stock, that was up, I think, around close to 3,500, 4,000 rupees. It's having around the 2,000, 2,200 rupee odd mark. What is your view on these capital market plays? For a longer term investor, it could probably make sense. Would you believe so? But the near term, that could be a lot of pain. Your take?
Great. Thank you for that question. Very interesting. And even before I answer that question, Nigel, let me wish you a very happy birthday.
Thank you so much, Manish.
So, looking at that capital market universe, you see, there are a few different segments over there. Number one, you have the wealth managers. You have the likes of, Angel One, Nuvama, who are targeting the retail clients, very high net worth clients. You have the exchanges, which basically have to depend on trading volumes and IPO volumes. And these exchanges are also much more regulated. They're also much more, if I may use that word, slave to the regulations which keep changing. So, for example, if you have the same expiry date across, all exchanges, obviously that has an impact on the trading volumes in the derivatives segment. So, I, for one, am more bullish on the wealth managers. Some of them are, despite the fact that they have run up, are still trading at reasonable valuations. Many of them have had earnings estimates being, taken up over the last 6 months to 1 year. So one has to tread carefully in this segment. It is a good choice for India, which is likely going to have a capital market boom over the next decade. But one has to be a little careful in his choice, in his top choice over here.
So Manishi, what are you most bullish on now at this juncture? You like wealth management, but what else?
I still like, and I may be sounding like a broken record here, I still like the private sector banks. India's 10 to 12% GDP growth would have to be financed largely by the private sector banks. Yes, the public sector banks would play a role, but the private sector banks would obviously gain a lot of market share over the next few decades. Their asset quality is way better than the public sector banks. Their valuations, look at HDFC Bank, which used to be at 4 times price to book. It has now come down to somewhere close to 2 to 2.2 times. So that is, really front and center of my sector choice. I also like consumer discretionary. Again, one has to be a bit selective about valuations here. I do like the four-wheelers, automobiles over there, and certain segments within the consumer discretionary. I would include the health chains, the domestic healthcare chains like the hospitals and the diagnostic chains in here. I also like the industrials selectively, including the defense names, which have run up too sharp and valuation support may not exist there. But a combination of government infrastructure investments and potential revival of private sector capex would have a tailwind on that sector eventually.
Manish, I just want to come back to that point that you made on consumption. You said you're not quite convinced and you're not sort of jumping from the rooftops with that theme. Just expand on that. Does that call only apply to, say, pure FMCG staples, or do you mean across the board? And if you are not too enthused with these GST cuts and the consumer space, just tell us why.
Well, I wouldn't say I'm not enthused in the consumer space, because if you look at consumer staples and discretionaries have, I think an outsized impact, as far as the GST cuts are concerned. They are much more price sensitive. I mean, the price elasticity in the consumer discretionaries are way more. We are already seeing that anecdotally in automobiles. So I'm actually quite positive on the consumer discretionary space. It is actually in staples where, the most of the companies, most of the sub-segments are actually very well penetrated in India. And they're trading at humongous valuations. That is where I am a bit cautious.
Okay, all right. I understood that point. On IT, what's your thought process? And I mean, how are you looking at IT in the traditional sense, IT services, and a lot of these new age companies that have now become part of the listed universe, right? So, and tell us how an investor should approach it. The traditional firms, they do have cash. They're willing to share cash with their shareholders, like we're seeing in the form of Infosys. So do these older stocks still have a tactical place in the portfolio? And on the other end of the spectrum, you have the platform companies, your food delivery, quick commerce, and now urban company, house help, etc. So much more. Where would you put them? And how much would you be willing to allocate to new age tech?
Right. So, again, to answer in a nutshell, in a single sentence, I would certainly be more enthusiastic about the new age tech companies. If you look at the traditional tech companies like the TCS and Infosys of the world, it is very clear that these companies, they don't really have too many avenues to invest the surplus cash that they're generating, and that is why they're resorting to buybacks. No doubt. It's good corporate governance to return excess cash to shareholders through dividend or buybacks. TCS has been doing it for many years. Now Infosys has joined the bandwagon. But it also tells us that the core business volumes that these guys were relying on, that is under threat, either from the geopolitical tensions in the Western Hemisphere or from the threat of AI, which is writing a lot of code. And therefore, this manpower arbitrage model is, unlikely to work for a very long time. On the other hand, the Zomatos, Swiggys of the world, they have a very fast growing market because despite the growth that they have had in the past few years, there's a humongous amount of space, a very large portion of the consumer, which still don't utilize their services. So yes, I think the headroom in that second space, the new age tech, as you call it, is a lot higher.
By the way, the Nifty Bank has dipped into the red. It's a minor 50-point downtick. But from the day's high, it's lost about 220 odd points, and autos have overtaken IT now as the top sectoral gainer. The auto index is up 1%. You've got Eicher Motors right on top. And Eicher Motors this month has added nearly 13%. Tata Motors, Hero MotoCorp, Maruti, M&M, all gaining about 1.5%. So the first 15 minutes have seen autos make a comeback, also buying interest in many of them. Manishi, so in the consumption basket, discretionary, give us subsectors or themes that you like. Is it airlines? Is it the hotel plays? Would it be the travel platforms like your Ixigo's and Yatras of the world? Would it be the luggage sectors, footwear? Is it trend and the likes? The themes in the discretionary consumption space, other than platforms, which attracts you?
So there are three broad areas that I would talk about. First, the domestic discretionaries, and right at the forefront are the automobiles, particularly the four-wheeler passenger vehicles, right? So they would likely grow faster than the two-wheelers, even though we are seeing some buoyancy in the rural demand as well. The second area would be the tourism-related sectors, and in that, quite a few smaller subsegments would come in, the hotels, the airline companies, the tourism platforms like you have. So, again, this sector, one would have to be a bit careful about the valuations. And the third, which I briefly alluded to, as the population becomes more affluent, they also become a little more health conscious. And this is not really a tailwind for the pharmaceuticals, but more for the hospital and diagnostic chains. So these are the three big focus areas for me right now, as far as discretionary consumption is concerned. And I think they will remain so for the time being.
Okay. All right, Manishi, we will leave the conversation there for today. Thanks very much for joining in. Appreciate you being with us. Have a good weekend, and we'll connect again soon. Well, that's a view from Manishi Chaudhary. The market is a little quiet this Friday morning, taking it easy, 40 points up on the Nifty. Mid-cap index has also cooled down a little bit from the opening highs. The Bank Nifty's got a little bit of a tinge of red on it, like Rima pointed out. So we'll see. It's a quiet start. Let's see if there's a pickup later. Let's focus on some stocks that are catching the eye. JBM Auto is definitely one of them. It's been up 5-6%. This company has managed to get some funding to purchase more EV buses. Let's go into the details with Sud. Sud, really revved up, JBM Auto.
That's true. So stock is currently up almost 8%. It's on the back of the announcement that company has made that its electric mobility arm, that is JBM Eco Life Mobility, has secured more than 100 million funding from International Finance Corporation. And that company is going to use that fund to buy and to bring those electric buses in the operations, and the number is going to be more than 1,400. It's 1,455, and also will finance the deployment of these buses majorly in 3 states for which company had bagged the tender under PM scheme, and those 3 states are Assam, Maharashtra and Gujarat. Now remember, government has a target to increase the penetration of electric bus to 40% by FY30. So the stock also has been moving higher for the last few months, and now on the back of this funding, today also it's up more than 7%.
Okay, got that, Sid. Thanks a lot for that. Let's hop across to Sonal. Sonal, tell us about Lodha.
Oh, yes. So Lodha is in focus because the company has signed an MOU with the Maharashtra government to the tune of 30,000 crore rupees. This is for green integrated data centers. The park will have a planned capacity of 2 gigawatts. It is designed to host multiple leading international and domestic players as well. The data center will be set up in Palava. And do remember, Palava continues to remain a big focus point for the company. In fact, in their Q1 presentation, they had indicated that Palava and Upper Thane will deliver 17,500 crores of sales in the next 3 decades with 50% EBITDA margins, and it will emerge as a data center hub as well, will create sizable recurring revenue stream for the company. The size is not given, but this is a move in the right direction, and that's why the stock is in focus today.
All right, Sonal, thanks a lot. Well, since you spoke about real estate, let's take the discussion forward. And to help us out, and we have our next guest on the show, who is Mr. Irfan Razak, the CMD at the Prestige Group. Thanks a lot, Mr. Razak, for joining in. Just give us a minute. We'll just run our viewers through the top 3 talking points that we're looking at. Point number 1, the demand trends in Bengaluru as well as in Hyderabad. Point number 2, the IT slowdown. Is it impacting demand? And point number 3, what are the pricing trends? Well, Mr. Razak, help us out with all of these then. Let's start off with the demand situation first in Bengaluru as well as in Hyderabad. Are you seeing some signs of weakness, both in terms of volumes, in terms of pricing as well? Because the indications are that IT demand has seen some kind of weakness. So is it reflecting on real estate demand?
Good morning, Nigel. First of all, let me wish you a very, very happy birthday.
Thank you so much, sir. Thank you for your good wishes, your support over the years. It's helped me a lot.
Now, to answer your questions, I think demand is pretty steady. Now, it also depends on which demand we are talking of. I think Bangalore and Hyderabad are doing extremely well. The only thing is in certain cities, like certain regions, some of the developers have made very, very large homes, and those are under pressure. But if I'm targeting the mid-income group housing with a decent ticket price, I think the demand is pretty robust and it continues to sell. And I think both in Bangalore as well as in Hyderabad, there's no change on any change in the IT hiring or whatever, because the economy is still robust and things are on ground very good. And you talked about pricing. Pricing also have stabilized, they've strengthened. At the same time, I think they've come to a level which has got the acceptability of the customer. We are trying hard to see that the price doesn't go too high too soon, because that's counterproductive. So that's always our endeavor, because one side the land price is high, the other side you have the construction costs, which are slowly creeping up. And with cement, the GST on cement being a little reduced, I think that will help us to contain the construction cost as well.
All right. What about NCR? That was one of the larger contributors, right? Some believe that maybe that market is peaking out. Would you concur, or do you believe it's got, a bigger headroom to move?
No, I think NCR has got a lot more potential. The only reason is the number of players are much reduced, and credible players are missing in that region, except for a few. And that's where the demand is coming towards them, including us. And NCR, we as a company have only one project which we've launched, and that has done very, very well, continues to do well. And we intend growing our footprint there, but surely, but steadily, and carefully, of course. And I think that is the strategy we have in the company.
All right. Mr. Razak, what about the office occupancy? That's the other spot that there has been some focus for you as well. So you help us with a couple of details. Office occupancy actually has been very strong. Could you tell us what is the total area under management, and what kind of leasing will you see for this fiscal year? And do you think this is the year for the REIT?
No, this is not the year for the REIT. Let me answer the last question first. I think we need to get a critical mass, and it will take us at least 3 more years or 4 years for us to get that huge mass that we are looking at. But on the leasing part, yes, you're absolutely right. Leasing has been pretty robust. We don't have any vacancies, or if the vacancies are there, it's just a few percentage, 3, 4, 5%. So that's the very, very positive trend. And even office, the lease rents itself have firmed up very nicely. Then again, it all depends on the product and on the location. If your location is good and your product is good, so automatically leasing will happen. But if you've got a rank bad location and a rank bad product, then there's a pressure. But I believe that the future is bright on office leasing. GCCs have now come in, and they are now bringing in the demand apart from ITES, so that helps the cause. And then, of course, data centers is the next big thing. But then data centers don't really consume too much space. What they need is a lot of power, and not the high-tech type of space, but high-tech in terms of the overall quality of power that we give them.
Mr. Razak, hi, morning, sir. Since you touched upon data centers, we're really talking about it today because one of your peer companies here in Mumbai, Lodha, they've announced a mega investment, I think 30,000 crores with the MOU with the state government just outside of Mumbai. How are you looking at this segment? I don't know if you already have, projects that you're building on the data center side, and just tell us the business dynamics. As a developer, is it remunerative to be getting into the data center business? Or, would you be better off doing what you anyway do, which is residential office, just in terms of margins and profitability metrics?
In the data center business, we will continue to be the infrastructure provider. We don't want to get into the data center business per se. We also, as a company, Prestige has signed a MOU with the Maharashtra government to do data centers. And the government is very keen to allot us some 50 acres in Navi Mumbai. And those discussions are on. And I believe that this is going to happen very soon. Apart from this, we're also looking at Andhra for the data center. We'll establish the data centers. There are many players who would like to operate that, and we are talking to them. So it becomes a win-win situation for the operators because they'll get a ready product. Because what they are looking for is the infra in terms of the setup of power, the setup of the building itself. And the buildings for data center are very, very different than what you do as an office building.
What I'm trying to understand, sir, the cost dynamics and the margins. Is the data center business more lucrative than, say, the regular office spaces that you set up, less, equal? Just trying to understand the business dynamics behind it.
The volumes may not be there in data center. You will definitely not get the square footage that you do in office space. But if you're asking me for return on investment, unless we don't get a decent return on investment, there's no sense in doing that business. So we look upwards of 15 to 18% return on investment. And I think that we should get that easily. And of course, there's no such mass sort of India now is a 1 billion square foot market for office. That can't happen in data centers.
Right. You spoke about that partnership, sir, with the Maharashtra government for data centers. I think that in Navi Mumbai, I think you all have also committed an investment of 12,500 crore for the same.
Exactly. Not only a data center, but also
logistics.
Logistics. So these are the two things that we had committed, and we have signed the MOU. And hopefully we will pursue this. It's not a partnership. It's the state government will support us in terms of providing the land, and the rest of the investment has to come from the company.
So what's the timeline?
And, we are pretty serious on that, and we shall do it.
Okay. So what's the timeline? When will all this come on stream, get commercialized? By when will you make this investment? It's a large investment of 12,500 crore rupees. And what is the expected revenue from it? You spoke about the IRRs before.
Yeah, I mean, see, it's not something that has to be spent on day one. So it's work in progress. The first thing is investment in the land itself. Then it's on the infrastructure, power, buildings, and all of that. So it's a outlay which will take between 5 to 7 years, starting from just now, which is the investment in land.
Okay. All right, sir. One final question then. How far are we from the IPO for the hospitality segment?
Yes, I think that's work in progress. The teams are working diligently towards this. And I think we should be about a month away from the listing, hopefully.
Oh, all right. So Diwali then, a good Diwali for that particular vertical.
Hope so. The teams are working. We've got the SEBI approval, but there are many regulatory steps that need to be done. So let's hope and pray everything goes well and we are able to do it as planned.
We're hoping with you, sir. Wishing you all the best. Appreciate you joining in. And we look forward to catching up with you to understand how the demand trends are going and also on that much-awaited IPO. Wishing you a good day ahead.
Thanks, Nigel. Thank you so much.
All right. Time to slip in a short break. After the break, we have Mr. Atim Kabra of Astro Micro. He'll be joining in. And Amit Mahajan of Paras Defense as well will be joining in to discuss opportunities from India's 15-year defense roadmap. You don't want to miss this.
Welcome back. Schloss Bangalore is seeing a bit of a pickup. There is an ambit note where they've initiated coverage. Their target price stands at 540, so that's a significant premium. The stock today is at 425, 3.5% up. It's compounding on luxury, and valuations too, according to them, are about 22 times 1 year forward EV to EBITDA. They like Leela and Samhi too in the hospitality hotel space. So now Schloss Bangalore, buy call 540 is Ambit's view on the stock, and that's pushing it higher today. But let's talk about Lupin. That's in news. Vinny joins in with an update.
Hi, good morning. So yes, we're keeping an eye out on Lupin. This is on the back of a brokerage note from Investec, where they've upgraded the stock to a buy from previous hold rating, increased the target price to 2,265 rupees. Previous target price was 2,100 rupees per share. Now, what Investec is saying, what are the positives that come in? Lupin will see a good benefit coming in from the GLP-1 opportunity that will start next year in India. So those generic launches for semaglutide that will come in, Lupin will be a big beneficiary. And do not forget, Lupin is already a key player in anti-diabetes as well as cardiac arrest therapies. So because of that, they'll always have an upper hand on that front and a beneficiary there. Now, other than that, recent approvals that have come in for Lupin are indicating its expertise in complex injectables. So they'll start benefiting on that injectables front for the company as well. And Investec expects a potential of around $20 million to $30 million annual sales for each of the injectables that are there. Post-correction, what Investec is highlighting is that now valuations are quite reasonable, and that is why for their base case, they're expecting strong FY26 performance, moderation in FY27 in terms of EPS, and growth will actually start coming back from FY28 and onwards.
Okay, all right. Thanks a lot for that, Vinny. Well, let's go across to Nimesh, who's here to tell us about Astral. Stock is high with a gain of around 2%. Nimesh?
Well, not only Astral, Nigel, the pipe companies are buzzing of late because there are a couple of initiating reports in just 1 week itself. After UBS, today JP Morgan has initiated a report on the pipe companies, and they have an overweight on both Astral as well as on Supreme. On Astral, they have a target price of 1,700, and on Supreme Industries, they have a target price of 4,700. For the pipe business overall, they expect the demand recovery at an inflection point. They see a demand recovery in second quarter and a margin recovery in the second half of FY26. In fact, JP Morgan expects a 17 to 18% EPS CAGR over the next 3 years. The only risk is the PVC price hikes which might come. So that's the JP Morgan call. Only 2 days back, even UBS had initiated on the pipe companies, and even they had a overweight on Astral, and they had a target price of 1,800 rupees. So net, I guess Streets is warming up to pipe companies for a recovery in the demand, and initiating reports coming in for Astral as well as for Supreme Industries.
Okay. All right. Got it, Nimesh. Thank you very much for that. Well, let's move to our next discussion then, and we're putting the spotlight on the defense space. The Defense Ministry has unveiled a comprehensive modernization 15-year roadmap for India's future-ready warfare programs. To discuss what this means in terms of an opportunity and a boost for the sector, we have two key players from the private sector space. Tim Kabra, Director Business Development and Strategy at Astra Microwave. And we also have Amit Mahajan, Director Technical and R&D at Paras Defense. Thanks, Mr. Kabra and Amit, for joining in. Great to have you both back on this discussion. So what we really want to just, break this down and understand what this means in terms of an opportunity and whether it gives an additional fillip to the plans and to the estimates that you were already working with. Mr. Kabra, if I could come to you, because this has been divided in a very comprehensive manner across the procurement that the Air Force will do, the Navy will do, and of course the Army will do. What have you made of the 15-year roadmap, and does it give any additional impetus or thrust to the procurement that we're already seeing?
I think it's a very, good morning. I think it's a very transformational document which shifts us from import dependency to be a globally competitive, self-reliant powerhouse, growing in exports and at the same time based on indigenous innovation. I think the critical focus here is on indigenization, modernization, and operational agility, which calls for fairly advanced capabilities, technological self-reliance, and collaborative growth. We are talking of advanced network-centric human-machine teamed platforms with real-time situational awareness, at the same time, which are cyber hardened, if I would say. So all I hear is solutions, right? And user requires timely solutions, and we need to respect that. Where do you really see user laying out his next 15 years roadmap? So to that extent, this is fairly transformational.
So, Mr. Kabra, are there any projects which are mentioned in this long strategic roadmap that you're already working on? And would you require to undertake incremental capex to meet a potential increase in demand?
The Astra has very deep footprints, as you are aware, both horizontally as well as vertically in microwaves, radars, electronic warfare space, So from that point of view, there are a lot of projects which are ongoing, which will be feeding into the requirements. At the same time, I think what we will see is resulting in multiple JVs across the industry, by the way, in my opinion. So our shareholders, for example, benefit significantly from one of our hidden gems, which is our 50% stake in a JV with Rafael Israel, which makes SDRs, software-defined radios. Right? So this is a company which can dwarf Astra, possibly, in years to come. And that results in kind of a collaborative approach and new technologies being brought in. So while we have our own capability set, which will work in very well with the requirements, but at the same time, I think there will be a need across the industry for multiple tech platforms to be brought in out here. And with the procurement process being in the process of being streamlined, I believe announcements are expected pretty soon. I think this should be resulting in a fairly set of business for the industry as a whole. Astra definitely will be one of the beneficiaries. But as I keep saying, this is not an industry which you should look at it on a quarterly basis, right? So you look at stacks of 2 to 3 years, and these stacks should result in significant incremental improvements, which are fairly irretrievable, if I may say. And we go from capability set to capability set. So this document kind of defines that.
All right. Hi, Mr. Kabra and Mr. Marjan. Mr. Kabra, since you briefly mentioned about that JV with Rafael, what kind of possibilities, what kind of opportunity size, if you could throw some color on that, because that clearly is something that, is exciting investors, but we don't really have a number or some kind of value that it can be given to it. That could be another hidden gem. Tell us more.
Absolutely. It is a hidden gem, which is not much appreciated outside, the company. But we are expecting this year itself should have at least $100 million assured kind of business order book in the JV. Of this, about 35% odd flows down to Astra itself. So it's a fairly significant business, which adds value not only to the overall space, but also Astra, which ends up doing significant work for the business.
Okay, so the JV itself. So the JV will create a value of about $100 million, right? And then it'll be shared.
Order book.
The order book.
Yeah.
Okay, to be obviously shared between Rafale and yourselves. Would that be correct?
It's a 50-50 JV, yeah.
50-50 JV, yeah. Okay. Gives us a sense.
Profitable JV, and there are not too many profitable such initiatives around, right? So it's a testament to the managements of both the sides that we've been able to do this.
Yeah, absolutely. I mean, all of you companies, along with the defense PSUs, all of you make us proud with going after, cutting edge technology and really bringing that Atmanirbharta message back home. Amit, let's bring you in as well. You tell us, and we want to really understand this from a shareholder perspective. People want to understand, how do things scale up? Say, let's look at the revenue numbers now. So Paras Defense, I think at the end of FY25, your revenue stood at about 370 crore rupees. So as you work on a lot of these projects and procurement orders, when does the big kicker come in? I mean, and I'm not asking you for 1 quarter, 2 quarters. Say 2 years down the line, what will the company look like?
So firstly, good morning, everyone. And thank you so much for having me on the show. It's been a while, and it's so nice that all the three of you I can talk to. And, like Atim Saab mentioned, I think what we need to derive out of this 15-year roadmap, and we need to understand it's a 15-year roadmap, this is an industry which is a long-term industry. This is not a short-term quarter-to-quarter game. But what is interesting to see is the impetus is being given on the legacy platforms, the legacy technologies, the upgradation of your existing military might. And there is a good blend of the new threats that you can see. You can see a lot of loitering munition. You can see a lot of UAVs. You can see a lot of anti-drone technologies being given that importance, because what we have seen across the world, these are the technologies we have now started influencing your security infrastructure. So in this case, what we are seeing is the technology readiness is not at one particular point, but it has divided into very many spectrum of technologies. And Paras, if you look at, we've always believed that because we are working for Ministry of Defense and we are working for this industry, we should have all the variety of products that we can offer. Yes, strong point of our company remains the optics and optronic systems, but we also are trading into defense electronics. We are also into electromagnetics. We are also into heavy engineering.
So we know that. Amit, we know that. We've spoken so many times. My question is very specific. Investors want to understand the scale up in terms of just the revenue pie itself. Like I said, you're at about 370 crores now. 2 years down the line, what are you gunning for? When do you touch 1,000 crores in revenue?
So if you look at the growth trajectory that we have given, 40-50%. Now, when we look at these kind of news coming in from the ministry, it only solidifies your future. You are not looking at an inflection point where you'll take this to 100-150% growth. You will phase it out. Everything does not come at one particular point. So these are programs which will percolate down, and you will have a linear growth. 40-50% when you're looking at a growth, this only justifies that and maybe improves that particular possibility.
Okay. If I could just get, since the idea of this is to reduce our dependence, increase our indigenous capability, Atmanirbhar, what would your dependence be on foreign imports right now, Amit? And how will that come down by? Is there any number that you could both, if I could request both of you to share with us, Mr. Kabra and Mr. Mahajan?
So we primarily focus on developing technologies all by ourselves. Yes, there are collaborations that we have with certain Israeli companies, and we are bringing those technologies to the country. But the dependency for justifying the opportunities that are lying in front of us fairly lies on the domestic development capabilities, which also include DRDO, and they are the backbone of our development. But the dependency on foreign technologies is limited, and it will reduce further from here on.
And for, if I could request Mr. Kabra as well, for you, for your manufacturing, etc., what is the dependence on foreign imports today?
I think it's the component level where a lot of components are imported. The basic building blocks, they get imported into the systems. And so I would say Amit is absolutely bang on target, right? As far as the solutions are concerned, it is the overall solutionizing which will be Indian, but I still expect that the chipsets, etc., which are not made out here, they will continue to be imported. So we have a fairly significant import content, if I may say, but usually that is passed on in the orders across to the clients.
Okay. And Atim, you spoke about enhancing exports. Exports is, I think, 10% of your overall revenue pie today?
Yeah.
Okay. Do you have a number in mind, say 5 years down the line, what that number could look like?
So I will make a distinction between deemed exports and exports of solutions. I would say export of solutions is something 5 years down the line should be at least 10 to 15% of the company from nearly zero at this point in time. And that's a very significant playbook that we are talking about, because by the end of this year, Astra is expecting that we will have completely indigenous, completely 100% Astra-owned, at least 3 radars plus very significant counter-drone systems with latest technologies built in multi-layered approach. And I think these are fairly global in nature. So we really hope to make a fairly significant dent. Plus our space business, we are more than a decade old in the space business. We are in conversations with guys who will source subsystems from us for their global space programs. I hope it works out pretty soon. You're already aware of our alliance with our arrangement with Teledyne, one arm of Teledyne. And we are really hoping that chip exports from our designed chips will also play a role in that. So at least 15% on an enhanced order book 5 years down the line from near zero will be the bare minimum that I would see for export markets.
Just very quickly, gentlemen, want to get your latest estimates on order book and order inflows for the next couple of months as well. And now in near term, we've spoken about the distance. Want to also get some near term clarity. Mr. Kabra, I believe your order book as of the end of first quarter was around 2,230 crores, if I have the right numbers. As you look ahead and as these roadmaps are announced, I mean, I'm trying to understand if the pace of awards is also increasing, if that's what you infer. And where do you think the order book position is going to be over the next couple of quarters? You'll be executing it as well, but in general, I mean, how will it move?
Astra has a guidance, if I'm not wrong, of about 1,300, 1,400 crores for the year incremental order book, which shall come in. The incremental part, right? Okay, which grows on, and then from that is reduced what we produce for the year. I think what we are looking at is, you're aware that we discussed last time, we have a significant order which has come in from Bell. And if we are able to procure that quarter end, it adds nearly 1,500, 1,600 crores over the years to our order book, right? Of which certain part will come in almost immediately. So we are fairly well placed, and we are quite confident they will achieve the order book that we are talking about.
And Amit,
we are talking of this 1,500 odd incremental going up to 3,000 plus.
Got it. So 1,500 crores, and if the BEL procurement materializes, then it will be going up to 3,000. Amit, same question to you very quickly. I think you are at just under 1,000 crores. What is the pipeline looking like for the next 2-3 quarters?
You're right. Our current order book is closing to between 900 to 1,000 crores. Yeah. We are looking at a good inflow of orders and a good revenue output as well. So with all of this put together, we should be closing this financial year with at least 50% better order book than what we have right now.
So 1,500 crores. Order book by the end of this year, 1,500 crores for Paras. Yes. Got it.
All right, very quickly, gentlemen. The scope is big, the opportunity is big. You have the government that's backing you all as well. Big runaway ahead. What about R&D spends? What is it currently, say, as a percentage of the sales mix, or if you could quantify it? And where do you see that headed? Because we have to be ready for a bigger runway, right? Amit, you go first.
So it's very tricky when you're working with defense and you're working with DRDO to earmark an R&D spend, because you're doing almost 30 to 40% of your revenues developing technologies with DRDO. So this is all that counts as an R&D effort that you're putting, you're developing technologies. So especially proactively doing R&D is on technologies that are new, those are global in nature. And here for Paras, it is less than 10%, about around 5-6%. And this will continue to remain here because we are extensively extending our R&D for DRDO.
Okay, got it. All right. Adim, you want to come in as well?
Yeah, sure. Guys, Astra is front-loaded in terms of its infrastructure. So we are not looking at any incremental outlay, which is dramatically different from our yearly outlay on R&D. We have built up very significant capabilities and the machines, the testing equipment. We are very well placed, I think, to deliver. I think what we need to do is to cope up with the enhanced business which we are expecting. We would be constructing within our premises another production floor, etc. And I think that's where a little bit of money will go in. But R&D wise, we are very, very comfortable.
Okay, all right. And just to clear the air, Mr. Kabra, you hold close to around 3% in the company. You were an investor and then you started heading the company, or because skin in the game is something that investors like.
Yeah, our board has, on the board we have nearly folks who represent nearly 23-24% of the equity. My personal equity, I control about 5.55% or 5.6%. Don't hold me to it. Approximately, that's the number which I control, of which part is in my name, part is in a holdco, which I control. Yeah, so there's very significant skin in the game for the board as well as all of us who are helping run the company.
Okay. All right, gentlemen. Great conversation, inspiring and spirited, and good luck to you, both of you, for all of those plans as India continues to move along the self-reliance path when it comes to defense procurement. Thanks for joining in. Well, with that, I think we've got some visuals coming in, and CP Radhakrishnan is going to be taking oath as the 15th Vice President of India. Remember, he was the NDA-backed candidate, of course, won by a clear majority. And I think shortly will be, those are the visuals coming in of the ceremony, and the oath-taking proceedings are ongoing. Okay, we'll keep playing those visuals. For now, a very, very quick break. Come back after the break and we'll get you a quick market update along with some more trading ideas.
Welcome back. The Nifty is still up about 70 odd points. JBM Auto is the star stock today. That's got a gain of close to about 8 odd percent. Schloss Bangalore, we were discussing it, that ambit note, 540 target price. Realtel continues to move up, and BSE has rebounded after the losses from yesterday. So that stands out. You've got Sigachi higher again. I think yesterday as well, the stock was up close to about 10 odd percent. This week, 35% up on Sigachi, Atul Auto, Shakti Pumps, Apollo Micro, Hindustan Copper too has been a big mover, and large volumes coming through on Hindustan Copper. So the mid-cap screen is quite vibrant, active, lots of individual stock movers. Vinay Rajani is now joining in. Vinay, chugging higher step by step. Markets have been consolidating with a positive bias. From here on, what's the trade?
Yeah, good morning. So, eighth consecutive session of rise in Nifty, and yes, gradually strength is coming in, though we are underperforming the global market. But going by the sectors and participation by the sectors, it looks like that Nifty is headed higher only, and we have been giving bullish view to our traders. So now the support for the Nifty is now 24,900, which should be utilized as a stop loss in trading long position. I'm expecting a short covering in the Nifty, and ultimate target of the Nifty should be 25,500 in next couple of weeks, we can say. So overall sentiment has improved, breadth of the market has improved, global market is quite good, and we have got a level about 25,000. There has been a downward sloping trend line resistance which has also been taken out convincingly. So yes, we are bullish with the stop loss of 24,900. One can expect Nifty to extend the gains, and the next resistance for the Nifty comes around 25,500, and Bank Nifty also we can see a movement of 800 to 1,000 points upside from this level. So yes, overall we are bullish, and stop loss in Nifty should be 24,900.
Okay. All right. That's at the index level. And what about stocks?
Yeah. So today defense sector has been doing quite good, and quite good momentum is there. So one of the stock which I like from the space is the Mazgaon Dock, which has given a fresh breakout on the charts. So after healthy correction, stock started performing well. So Mazgaon Dock around 2840, one can go long. For trading, I would suggest a stop loss at 2770. On the upside, I'm expecting a target of 2950. The second pick I would take from the private banking space, that is Axis Bank. So around 1100, 1104, one can go long. 1085 should be the trading stop loss. On the upside, I'm expecting a target of 1140.
Okay, all right. We'll leave it there. Vinay, thanks for joining in. Need to take a quick break. Come back on the other side. We'll be in discussion with two experts. M&A is going to be on the radar. Sumit Abrol of Grant Thornton and Bharat Bhavesh Shah of Aquarius will join in. We'll talk about the trend of outbound M&As from India and what it's telling us. Welcome back. M&A is on the radar, and we have two experts to talk about the trends. Sumit Abrol of Grant Thornton, and we have Bhavesh Shah of Aquarius with us. Thanks very much, Sumit and Bhavesh, for joining in. And, the genesis of this discussion is obviously some of the latest announcements, including the one that came in from Tega Industries, a small company looking to acquire an international giant. And it seems that, leverage buyouts perhaps are coming back in fashion or back in trend, at least in this example that I just quoted. But you tell us, how do you rate and rank some of the outbound activity that we've seen over the last 12 months from India, and what lies ahead? Sumit, let's open with you.
Yeah, thanks for having me on the show. And I think let me start with two simple words: very activated. If I recall, last year, 2024, we saw about 120 odd cross-border outbound acquisitions valued at about $17 odd billion. This year, 8 months fast forward into August, we've already seen transactions worth about 11 billion already getting transacted, about 100 transactions already done. And all this activity cannot just be concentrated and driven by the mega deals. So there is very significant mid-market participation in outbound cross-border activity. And that is expected, with what we've seen in the last 5 years in India, with Indian corporates not being in a better position or in a better shape to go after outbound expansion, with buoyant domestic demand, very healthy balance sheets, a very strong and supportive banking ecosystem, and very importantly, favorable capital markets, which are creating headroom on equity dilutions, which is creating that muscle power to support some of those exotic buyout structures, as you said, leverage buyouts, debt financing with equity coming in. And then, of course, there is that increasing gap in domestic versus international acquisition pricing, which is creating that headroom to deliver shareholder value. So I think overall, extremely exciting times and aggressive deal making by Indian buyers. And we are increasingly seeing a lot of Indian participation on most global deal tables, which are in play.
Sumit, lots of interesting points that you've raised, but let me pick on the last one and go to Bhavesh on aggressive deal making. Bhavesh, yesterday we had that big announcement by Tega, and Sumit was also talking about the rise of these mid-market champions from India going abroad, buying large assets. Look at Tega's example. It's a 13,000 crore market cap company, and they've gone ahead and acquired a company exactly of the same size, similar size. What are the pros and cons? Because there is some fear that Indian companies perhaps, or maybe in this particular transaction, you're stretching yourself too thin to make this buyout.
Good morning, and thank you for having me. I think there has always been an urge in the corporate India to kind of do outbound acquisitions. And we have seen this happening even in 2006, 2007, preceding the global financial crisis. And after the GFC, the trend kind of started, waning down. But the technology, the market positioning, the products that you get through international acquisitions is at a different level. I think the new drive is also driven by one of the major things which is now happening globally, which is the global trade rebalancing, which is happening across countries, driven by US tariffs. So the companies are even thinking about how do we now play the future in terms of markets, in terms of products, how do we export, how do we kind of place ourselves in terms of manufacturing. These are some of the important factors which is driving the corporate India in terms of the strategies. Some of these companies are large. They are, from a risk perspective, yes, the companies which are acquiring from India are, they're comparatively significantly larger in the international markets. But the question over here is, are the cash flows good enough to take care of the debt servicing that the companies are using to acquire them? And as long as the cash flows are good and there's a good amount of buffers which are put in as far as the operating cash flows are concerned, this may make sense with the very careful safeguarded measures. The outbound M&A can continue to do pretty well.
Absolutely, and that's really important, and that's exactly what we want to understand, whether the conversations are being as nuanced or not. And maybe quick sense from both of you, Sumit, on this. That's exactly my question. As deal makers, of course, your job is to get the deal, on the table and get it signed. But from a shareholder perspective, it's very important that a lot of the details, the intricacies that Bhavesh was pointing out are taken on board. So the deals that you're seeing off late in the conversations, I mean, how much of it is bravado because maybe there's easier PE money or easier access to funds? And how much is coming in from just maturity and very careful consideration?
So maybe I can come in there and just to kind of counter that point. Yes, as deal makers, the idea is to get deals done, but it all starts with establishing the strategic fitment, which I think is top of the considerations to build any M&A rationale. The moot question here is M&A risky as a corporate strategy? I mean, of course it's risky, but is it any significantly riskier than putting any new capital expenditure or launching new products or getting into new markets? Perhaps yes, but I think Indian corporates, as I said today, are in a position to better manage the nuances. First of all, the willingness to assume that risk on back of strong tailwinds, and then ability to manage that risk is at an all-time high. When we look at transactions, there are clearly 3 or 4 things that stand out. The first test is, as I said, strategic fitment, and we are increasingly see that a lot of these acquisitions are being done to fill in some very serious capability gaps versus these being just pure value arbitrages. And of course, there are favorable financing structures to these Indian companies which they have never been exposed to, which are now available in international markets, which are fueling some of that activity. But what I can tell you is what we are not seeing. We are not seeing any big ticket deals breaching some serious deal discipline on fitment. We are not seeing any billion-dollar gambles as yet on untested, non-profitable, high-risk business models. Some of that activity which has been more localized. I don't think we are seeing some of those trends and themes in international activity. And I'm seeing that increasingly Indian corporates are seeing this as a real opportunity to seize the global center stage and to build some of those multinationals from India. So I think broadly we are okay in terms of the overall discipline that we are seeing on transactions right now.
Sumit, are we seeing similar? Yeah, go ahead, Bhavesh.
Yeah, and to add to that, I think we as investment bankers, at least at Equitas, we kind of don't think about ourselves as transaction bankers, but as relationship bankers to the corporates. So we would always advise what is in the long-term interest of the companies and the shareholders. Now, in that regard, it is very important that those safeguards which I mentioned earlier are in place. But what we are seeing also increasingly is even the corporates are very, very careful in what they are doing. I mean, of course, these are opportunities which need a very short time of decision to kind of, turn around and say, yes, we are there, we are not there. But at the same time, there is a lot of thought process which goes behind whether does it make strategic sense and what is the risk involved if either of the variables, which is operating cash flows or the debt or the market changes, these are definitely considered while going ahead with.
That's really good to know. It's very reassuring to hear that the aggression is measured, it's careful, it's calibrated. Very quick 10-second answer. So then the next hot sectors, the next set of big deals, where should we keep our eye on? Bhavesh, quickly, 10 seconds.
Yeah, I think industrials, pharma are one of the bigger areas where we can see some action over here.
Sumit?
Yeah, so the tailwinds of the shift in global supply chains will keep manufacturing industrials very hot. Technology-led acquisitions will continue to be in flavor for acquiring capabilities overseas. And then, of course, pharma is always right up there for big ticket deals on outbound.
Okay, gentlemen, we'll leave the conversation here for now. Thank you very much for joining in. Well, that brings us to a close in this edition of Bazaar. We leave the markets higher for the 8th day in a row, 0.25% up on the key indices. Thank you for watching. Don't go anywhere. Chartbusters is up next.
The Indian market joins in the global equity rally. The Nifty opens higher, sustains above 25,000 as autos and banks surge. FMCG stocks, however, see some profit booking.
Infosys announces its largest ever buyback worth 18,000 crore rupees, where it will buy 10 crore equity shares at a price of around 1,800 rupees per share. The stock is trading higher, though it's off the morning highs.
Lodha Developers trades in positive terrain, though off